As IV lives, prices get expensive.
Welcome back, traders. This is Sandra with Trading Made Simple.
So a leader, if you're above that 20 EMA, if the CCI is above the 100 or it's holding above that point of control SVE pivot that we give you. If there's a pullback and you're looking at the chart and you see it dips below the 20 or the point of control bounces while that CCI is rising, then, oh, looks like possibly a trend change here, or that it just came and tagged point of control, an important level before continuing in the uptrend. Because as trends are created, you have higher highs and higher lows. So it looks like a check mark. And so that's how a trend is created on a chart. And same for a downward. It's going down. It wants to retest that support level that it broke, and then it continues to go down again. And so these are the items that we give you that you can easily create a nice little checklist on your watch list. If the price range is between the pivots or near the CCI 0 line, it's flat, something's building. And then also always keep in mind, earnings, keep sizes small. Why do we do that? Because there's a lot of action that takes place during earnings. A lot of institutions get involved in earnings trades. And so you want to keep that size small, use defined risk. This is important because if you have an account like a 401 or an IRA, these you'll have to check, of course, with your provider, but a lot of these will allow you to trade with your account if they are defined risk. We only use defined risk. So I want to let you know that. Very important. Price and volume. So I identified the tools that we recently just gave you with autopilot. And I'm showing you that with those tools, you can actually identify if price and volume is coiling. So let's get into that. So when the market's really not doing anything, how do we know that? I should break that down. We know that because the candles on the chart are small. If the candles are small, not a lot of volume. The candle is large, lots of volume. And so as the price bars get shorter and shorter, like nothing happening. Usually when those price bars are shorter and shorter, they're typically grouped together, like on a day chart. You'll see them all together. And they might be a little higher, might be a little, but they're really tight. And they're like just going sideways. We call this consolidation. Whenever there's consolidation, the market makers are up to something. And so now you need to determine from that coiling and consolidation, will it break to the upside or downside? That's why we want to be prepared. So what's an inside day? An inside day is when you find a candle, let's say yesterday, and then today's candle, my range, high and low, right? This is yesterday's candle, high and low. Today's candle, high and low, is actually inside that range. That's actually called an inside day. What's an outside day? When it surpasses either of these, either the high or the low of yesterday. That's all that means. It's as simple as that. So when you have an inside day, that means price is tightening, it's coiling. Had a big move, and all of a sudden today is a small candle and it's inside that range. That's another indicator. Volume. So what's today's volume? Like normal volume, right? Is it more? You can actually do a chart setting on your chart to visually see volume. You can also look at the trade tab on ThinkorSwim. That shows you the volume. If you're not used to actually identifying it, it's probably one of the items that you could start taking a look at. And why is volume important? Because if I see what today's volume is, and then, or excuse me, if I see what yesterday's volume was on that big candle, and then today or maybe any candle, let's say now we had the big candle and then we had the little candle, because the little candle means coiling. So we got the little candle here. And so what am I looking for? I'm looking to see what that big candle, how much volume did it create? And then that little candle, how much volume did that create? You can actually see a lot of movement based on volume. And then the 20, do we have a pullback that holds that 20 EMA? If you've been following me for a little while, whether it be on my YouTube channel or Twitter, you'll know that I often talk about that 20 EMA as being the best trend identifier. Anything above that 20 is bullish. Anything below the 20 is bearish. It's so simple. A beginner can understand this. and it works on every time frame. So when you have a pullback, a lot of people get nervous. And I'll tell you something, buy low, sell high. How do you buy low when you're nervous about a pullback? Maybe you lost $500 on that Friday tweet, but the fact that it came underneath the 20, came back to the 20 and then jumped back above it, because that's what happened if you look at your chart on SPY, then you'll go, oh, wait a minute, we were in an uptrend. We had a news event, overreaction, coming back up, broke above the 20. Breaking above that 20 line is important because that means we just broke through resistance. So what else are we looking for? CCI to break above that 0 line. Hey traders, if you're finding this helpful, go ahead and tap that like and subscribe. We drop fresh trading setups and automation tips every day. And trust me, what's coming up next could level up your game. The links to learn more about us and our system is in the description below. Let's talk about options. Are big traders leaving cues? What kind of cues do institutions actually leave a trader to identify what's happening? So a lot of new options at round strikes. You know where you find this? Right on your platform, right in the trade tab. You can actually see volume and open interest right there. You can actually see where you can customize your little column heading so that you can actually see those tools. So you can actually see where the volume is on the strikes. And typically, they're typically near big numbers, 100, 105. If it was SPY, 650, 655. It's more like in the $5 range on SPY. SPX, it's in the $50 range, each $50 increment. The other way that you can notice is that puts get really expensive. And that's because something's going to happen in the marketplace and the institutions are hedging their positions. And then the calls, let's say we're in an uptrend and you're thinking that it's going higher, the calls start actually being cheaper. This should be a warning sign to you, actually, because if the market goes higher than demand, you would think that the calls would get more expensive. But if there's a big move coming, as an example, and this could be, and remember, whenever I speak of something on the bullish end of my conversation, it's exactly mirrors the same thought process and analysis for bears on the bearish side. So as I'm describing this, it's the same. So if calls are getting cheaper, but prices going higher, stand by to stand by. It's what I would say in the cop world. Stand by to stand by. Something's about to happen. These are just little tidbits as you start to get more experienced, as you start to look at the tools on your own platform. And remember, that's how we actually teach you autopilot, is using your own platform. What is IV? IV is implied volatility, that someone expects a move when IV starts to rise. Implied volatility is rising. And I say someone, I think that's a typo. It should be the institutions expect a move. Because if I placed a trade on today, could you see my money in that candle? Heck no, no way. You can't see my money. Anything that you see on the chart is all institution buying and selling. It's not my portfolio. Even if it had $1 million in it, it's not representation. Remember that we have trillions and billions of dollars in our market. Big piles near price can act not only as walls, resistance, and support, but also can act as magnets. So when you're looking at the trade tab and on one of your columns, open interest, those large numbers, one that's got, I don't know, 50,000 contracts where everything else is 5 or 10,000 contracts, that is an identifier. And that could either be a magnet or support and resistance. So if you look at the chart and you see where price is right now, and then you look at where either that wall or that magnet is, that could really help you identify what could be happening. So these basically are footprints. They're like clues, like we're on an investigation. We're at a crime scene. Hopefully not a crime scene, but we're really wanting what I say crime scene in the police world, but in our own lives, in our own professions. Aren't we doing research? Because that's all that is. One piece of information is helping you to identify your thought process and where you might be going with. We do that when we invest, when we choose financial planners to manage big money or real estate projects. So this is just, I use that because it's my old world, but actually I use that every day in everyday life. So big block trades at the same price again and again, If you're paying attention to option institutional flow, you can see the accumulation rising, or you can see the selling begets selling, right? Just keeps going and going. Or you have insider trading information that's showing you that big administrators within a company is selling a lot of their stock. These types of things are pieces, they're clues. Remember, before CPI, Fed earning, IV typically lifts. So typically what the marketplace does is it acts like a store. And what used to you be shopping at a store like Walmart, as an example, and you're looking at price tags, as IV lives, prices get expensive. All of a sudden, what you thought, you saw the price of a call yesterday, we're at or about the same price, where we're at right now. And you can see that call is like more expensive. That's because IV is lifting, because the marketplace is saying, hey, wait a minute, everybody. We got a news event coming out tomorrow, FOMC as an example. And the day of the news event, whoa, be careful. Those prices are so expensive. You might overpay for something. And as soon as the event is over, you get an IV crush, which means that you were at Walmart, you saw the price today, it was on special and discounted. You came in today, you're not paying attention to any of the news events. You don't even know anything that's going on with that. So you end up buying a call or a put based on your research. But you do notice that it's expensive. Why? Because the Nordstrom retailers just stepped in and took over. And then all of a sudden, as soon as the news event is over with, all of a sudden you're sitting there holding this purse that really was $10 yesterday, is now $100 today. Now the marketplace goes back to the Walmart pricing, and you're sitting there holding a $100 bag, and now it's only worth $10. That's what IV does. That's why you need to pay attention to it. Watch the IV start to rise. Prices is just going sideways. If there's any type of news events that are popping up, be cognizant, because that usually makes IV rise. Things start getting expensive. You want to be careful of that. And then always look for SVE pivot areas for breaks or bounces with volume, right? What was yesterday's volume compared to today? There's a lot of tools out there that'll just give you the average so that you can identify if there's actually like real movement, or if the volatility is like really low comparably to an average. Just like we use that 20 EMA, that's an average of 20 bars, regardless of what chart you're on. It's the same with volume. So there's a lot of tools that we can get into with that. Maybe that's what we'll do next week.